Did you know that financial scams are on the rise? Scammers are exploiting weaknesses in financial reporting and audits to commit fraud. It's crucial to understand how these scams occur and how to protect your organization. Financial reporting and auditing are meant to provide transparency. But when poorly executed, they can leave companies vulnerable to fraud. Scammers find and exploit gaps in these processes, manipulating financial statements and deceiving investors. One major weakness is a lack of transparency and inadequate disclosure. Companies must clearly disclose all financial details. If they fail to report liabilities or related party transactions, fraudsters can easily hide their activities. Take Enron, for example. They used complex structures to hide debt and inflate earnings, leading to their collapse. Another significant issue is weak internal controls. Without proper segregation of duties, one person can have too much control over transactions. This creates opportunities for manipulation. A notable case is WorldCom, where employees inflated earnings by capitalizing operating expenses. Years passed before anyone realized what was happening. Inadequate audit procedures also play a role. Auditors must approach their work with skepticism. If they overlook suspicious transactions, fraud can easily go undetected. The Wirecard scandal illustrates this. Auditors missed critical discrepancies, allowing the company to falsely report profits for years. Automation is essential in modern finance, but over-reliance on systems can be risky. When there's little manual oversight, it's easier for scammers to slip through the cracks. Bernie Madoff's Ponzi scheme thrived on this lack of scrutiny. His firm relied on automation to process transactions, and the fraud went undetected for decades. So how do scammers exploit these weaknesses? They manipulate financial statements to paint a false picture of performance. They may inflate revenues or hide liabilities, making the company appear healthier than it is. This can lead to inflated stock prices or unauthorized loans. Moreover, weak internal controls can enable embezzlement. Employees might falsify reports or alter payroll information, allowing theft without detection. Scammers also take advantage of audit lapses to hide their activities, providing misleading information to auditors. To fortify your financial reporting and audits, consider these key strategies. First, strengthen internal controls and segregate duties. Ensure that the person processing payments is not the same one reconciling accounts. Regularly review controls to reduce fraud risk. Second, enhance audit procedures. Auditors should rigorously scrutinize financial statements and question any unusual transactions. They need to be independent and empowered to investigate irregularities. Next, improve transparency in financial reporting. Companies must fully disclose all liabilities and transactions. Clear financial statements make it harder for fraudsters to exploit weaknesses. Finally, utilize technology for fraud detection. Automated systems can flag anomalies in data, assisting in identifying potential fraud. But remember, technology should complement human oversight. In summary, scams thrive on weaknesses in financial reporting and auditing. By strengthening controls, enhancing audits, improving transparency, and utilizing technology, organizations can protect themselves. Stay vigilant, skeptical, and proactive to safeguard against financial fraud.